Trump has shifted focus once again. After the failed attempt to force India and China to abandon Russian oil, he is now targeting Moscow directly with a new package of sanctions. But there is a nuance. In the year 2025, while the dollar is losing ground, the Russian ruble is showing far greater resilience than anyone expected. And what is even more surprising is that these sanctions have brought far less impact than anticipated. Yes, Russia's economy has slowed down, but the sectors that seemed doomed, industry, energy, even parts of the technology sector, have managed to recover and gain new momentum. The biggest shock is that at certain moments during the year, the ruble traded stronger than the dollar. For Washington, this is a scenario they were clearly unprepared for. This story has another consequence. The more the White House presses with sanctions, the more actively other countries look for protection against such dependence. Even the closest US allies are beginning to develop trade and financial systems where the dollar does not play a central role. Everyone understands how quickly Washington can turn finance into a weapon, and no one wants to be that vulnerable. And here arises the main question: what can new sanctions actually achieve? Judging by previous years, the effect will be limited, unless Trump decides to put pressure on China. It is precisely Beijing that has become the main pillar of the Russian economy. Without Chinese trade and loans, Moscow would be facing a far tougher situation. But putting pressure on China is a step with far higher risks. In that case, America's own supply chains would come under threat. This story goes far beyond Russia. It touches the balance of global power, the survival of national economies, and a much more serious question that Washington prefers not to voice. Who actually holds the advantage in this struggle? Let us consider an example. Just a couple of weeks ago, Washington hit India with tariffs of up to 50%. The message from Trump's team was clear: punish New Delhi for buying Russian oil. But India did not flinch. Officials stated, "No one will dictate to us from whom we buy energy resources." For India, cheap Russian oil is not politics, but economics and energy security. Millions of people are moving into cities, factories are expanding, and the middle class depends on stable fuel prices. New Delhi cannot sacrifice growth just to please Washington. This firm stance reflects a much broader trend. America is finding it increasingly difficult to influence the decisions of other countries. For decades, US pressure was weighty enough to force governments to adjust. But now, from New Delhi to Beijing, and even in smaller economies, more and more countries are pursuing their own course. This worries Washington, since sanctions remain its primary instrument. And this brings us directly back to Russia. Today, the US is debating a tightening of the sanctions regime. To grasp the scale, it is worth recalling which measures are already in place. Russia is living under one of the harshest packages of restrictions in modern history. Under sanctions are banks, shipping, aviation, insurance, and high-tech sectors. State banks are cut off from global financial systems. Companies have been deprived of Western capital. The export of chips and equipment is restricted. On top of that, there is a price cap on oil, $60 per barrel. Russia cannot sell above this level if Western shippers or insurers are involved. Energy remains the most vulnerable point. Oil and gas have been the foundation of the Russian economy. Before the break with the West, Europe was the largest buyer. More than 150 billion cubic meters of gas per year and over 2 million barrels of oil per day. That market is gone. Europe sharply reduced its dependence, and supplies to the West collapsed. Moscow hastily redirected exports to the East, where China and India became the main buyers. Beijing stepped in especially strongly when India reduced purchases. But this could not fully offset the losses. Russia sells Urals crude at a discount of $15 to $20 to Brent and bears higher transportation costs. As a result, oil revenues fell by almost 30% compared to pre-war levels, hitting the budget hard. Yet it cannot be said that Russia has fallen. The country has managed to adapt to preserve trade. More than 600 tankers of the Shadow Fleet carry oil beyond Western control. Settlements are increasingly conducted in yuan, rupees, and other currencies. On paper, each package of sanctions looks harsh, but in practice, the effect is weaker than declared. Washington is betting on punishment, while Moscow is betting on adaptation and new connections. And with every step it becomes clear, Russia is far from isolated, especially as China and India deepen cooperation with Moscow in response to US pressure. Today, we are witnessing a test of the limits of American influence. Russia has lost part of its markets, but it has redrawn the trade map. India has not yielded to US tariffs, and China continues to expand energy deals. New sanctions may be announced again and again, but the main question is, how much does Washington still control global trade flows? And the more countries begin to ask this question, the sharper the debate becomes. But one of the biggest surprises of the year 2025 has been the return of the ruble. When sanctions were first imposed, almost all analysts predicted collapse. The exchange rate crashed above 120 rubles per dollar, and many thought that uncontrolled decline would follow, leaving Moscow unable to finance imports and contain inflation. Western leaders pointed to the ruble's fall as proof that sanctions were breaking the Russian economy. But today, the picture is completely different. The ruble has managed to regain ground, stabilizing in the range of 80 to 90 rubles per dollar, and at times even performing better than the dollar itself. Inflation, which in the year 2022 jumped above 17%, by the year 2025 has fallen below 9%. This resilience has caught both Washington and Brussels off guard. Instead of a collapsing currency, they are faced with a ruble that at times looks more stable than the dollar. Such recovery is largely tied to the world's reaction to American restrictions. Every time the US cuts a country off from banking networks, freezes reserves, or threatens secondary sanctions, it reminds the world how much America controls the system. But that control no longer inspires trust. On the contrary, it pushes governments to seek alternatives. Even allies are beginning to feel like suspects. Leaders from Asia, Africa, and the Middle East ask the same question. If Washington so easily turns the dollar into a weapon against rivals, what prevents it from doing the same with friends? This fear is no longer theoretical. It is reshaping the rules of the game. As a result, the dollar is gradually losing its dominance. Russia and China are shifting most of their energy trade into rubles and yuan. India is testing settlements in rupees for Russian oil. The Gulf states, which for decades adhered to the petrodollar system, are beginning to discuss oil deliveries to Asia with payment in yuan. Each such step undermines the central role of the dollar in global trade and finance. For Trump, the consequences are serious. He himself often warns of the risk of de-dollarization, but his tariff wars and sanctions only accelerate this process. The harder he presses, the faster countries create alternative systems. And once these systems gain scale, bringing them back into a dollar-centered order will be far more difficult. The question many are now asking with growing tension is whether Trump will decide to impose sanctions directly on China for buying Russian oil. The stakes here are much higher. At first glance, such an approach seems contradictory. If the US goal is to cut off Russia's revenues, then China should be the main priority. Chinese companies are not only buying oil, but also selling Moscow vital equipment, electronics, and goods no longer supplied by Western firms. Yet Trump has not taken the step of direct confrontation with Beijing. The reason is simple. Striking China could blow up the very supply chains on which the American economy depends. The main barrier is tariffs. The US-China trade war, which began several years ago, has already pushed duties to a record level, more than $300 billion in annual trade. American importers pay for this, and the costs are passed on to families and businesses. If Trump were suddenly to add Russia-related sanctions to this conflict, it would ignite an even greater escalation. This explains the selective approach. India can be pressured with tariffs, but with China, Washington must act more cautiously. Yet the cost of this caution is clear. As long as Beijing buys Russian oil and trades freely with Moscow, the sanctions regime remains incomplete and far less effective than Washington intended. This story is still unfolding. Every new tariff, every fresh sanction pushes the system closer to its breaking point. The stakes are rising, and the balance of power is shifting faster than Washington can respond. And the main question now sounds like this: will the United States continue to set the rules of global trade, or is that role passing to its rivals? To stay updated on these events, subscribe to the channel and turn on notifications. See you in the next video.